Hi there. Welcome to this beginner-friendly guide to investing in the stock market in 2024. Whether you're looking to grow your savings, build long-term wealth, or just curious about how to start, this video will break it all down for you in simple steps. Grab a notebook, because we're about to unlock the secrets of smart investing. Section 1. Why start investing now? The stock market has historically been one of the best ways to grow your wealth over time. Even if you start small, the power of compounding can work wonders for your future. And here's the best part: you don't need thousands of dollars to get started. With apps and online platforms, you can start investing with as little as $10 or $20. Section 2. Step 1. Understand the basics. First things first, what is a stock? A stock is a small piece of ownership in a company. When you buy a share of Apple or Tesla, you own a tiny portion of that company. Stocks can make money in two ways. Capital gains, when the stock price increases. Dividends. Some companies share their profits with you. Section 3. Step 2. Set clear goals. Ask yourself, why am I investing? Is it to save for a house, retire early, or just grow your money over time? Your goals will help shape your strategy. Remember, investing is not a get-rich-quick scheme. It's about consistent growth over time. Section 4. Step 3. Choose an investment account. Next, you need a brokerage account. This is like a bank account, but for buying and selling investments. Some popular options include Robinhood for beginners, Fidelity for research tools, or Vanguard for long-term investors. Look for accounts with low fees, user-friendly platforms, fractional shares. Section 5. Step 4. Learn about investment types. You'll come across terms like ETFs, index funds, and individual stocks. Here's what they mean. ETFs, or index funds. These are baskets of stocks that give you instant diversification. Think of them as a sampler pack. Individual stocks. These are riskier, but can have higher returns if you pick the right companies. Bonds. These are safer, but offer lower returns. Section 6. Step 5. Start small and be consistent. You don't need a huge lump sum to start. Begin with what you can afford and invest regularly. This is called dollar cost averaging. For example, if you invest $50 a month consistently, you'll take advantage of both market highs and lows, reducing your risk. Section 7. Avoid common mistakes. Here are some mistakes to avoid. Don't panic sell during market drops. Avoid trying to time the market. No one can predict it perfectly. Don't put all your money into one stock. Diversification is key. Section 8. Final encouragement. Remember, investing is a marathon, not a sprint. The sooner you start, the more time your money has to grow. Start today and thank yourself later. And if you found this helpful, hit the like button and subscribe for more beginner-friendly